Something strange is going on with these markets, everybody. I'm going to be going over 7 warning shots that are being fired by the markets that I think we don't maybe need to put too much weight on. However, we need to have them in our back pocket and be aware of what's taking place, really behind the curtains, behind the scenes, things that maybe most people aren't even paying attention to. That's what we're going to talk about on today's Stock Market Brief Show, where we navigate the financial markets through the lens of technical and intramarket analysis. If you haven't done so already, make sure to hit that thumbs up and subscribe to the channel if you like this type of content. We're going to start off at the daily chart of the S&P 500, and one might think that we're just getting a little bounce and market's moving up higher and everything's fine. It's just a little bit of a pullback. And we'll touch back in on this of really how to navigate this specific market in the near future. But I want to specifically start here at the warning shots that are being fired. So we'll look at number 1. First off, take a look at the weekly chart of gold. Gold is known to be more of a safe haven. Well, we've been not only breaking out on the weekly time frame, but on the daily time frame. We just closed here at another all-time daily high. So gold is reaching to all-time highs, which all-time, that's a very long time in this commodity, and it's known to be much more of a safe haven. Now, while this is taking place, brings me to warning 2. I've been taking a look at a lot of these defensive military type names, right? So, for example, Lockheed Martin manufactures military aircrafts, missile satellites, submarine combat systems, missile defense systems, etc. Well, these things have been exploding. If we're just looking here on the weekly time frame, look at this monster breakout at highs for the year, which potentially could be all-time highs. I'm not too sure. I didn't look too far back, but we're talking multi-year highs here. Take a look at GE Aerospace. Now, they provide jet and turboprop engines as well as integrated systems for commercial, military, and aviation aircrafts as well. And this is we're a few days separated from the all-time highs, or at least the highs for the year. Once again, I didn't go back far enough to see if it's all-time highs, but the trend is very strong in these names. Take a look at Northrop Grumman, which is NOC. I think I pronounced that correctly, but also another military mission system aircraft for defense. This has been breaking to highs for the year after a little bit of a sell-off, and we're seeing, we had earnings, it was powerful, and we're having some follow-through there, and we just recently closed at a new year-to-date high for this as well. I could keep going. Look at RTX. RTX provides aerospace and defense systems for service of commercial, military, and government customers, and this one also, monster earnings flagged out, and we're a day separated from a new high from a year-to-date standpoint. And then if you look at something like ERJ, now this is a Brazilian manufacturer for aircrafts, but they also look into defense and security applications. And this one as well, which I've traded this one multiple times through this year and the last year, is that it just hit a new high from year to date. So gold, right? Number 1, we're at new all-time highs. Warning shot number 2 is a lot of military type names, defense type names are floating around and seeing massive strength. Let's take a look at warning 3, and that has to deal with oil. Now, the fast moves in oil, dating back all the way to the oil embargo, large spikes in oil have caused economic turmoil. But what we're seeing right now is really oil is somewhat confused. It's bouncing back and forth, but it is in a monster compression pattern where we're putting in lower highs and higher lows, and we're seeing some strength as it stands right now. While oil volatility, by the way, is rather elevated. After seeing a pretty large move there in July, it backed off a little bit. So July came off a little bit. We saw a move, and we're kind of just flown at a higher level here that we haven't seen. We haven't been trading too much around there for the majority of the year. So that's another sign that I'm kind of keeping an eye on there, is that the moves in oil here. Let's look at warning number 4. And that has to deal with the bond market. So, for example, TLT. We saw a recent very strong breakout on strong volume in TLT. This is another one of those compression patterns, the higher lows, the lower highs, and boom, we saw it shot off. And a move like this typically reflects more of a flight to safety, right? And that's typically what bonds are for, which they haven't seen that like that way, but this move here did coincide with somewhat of a flight to safety while the market retraced in recent trade. And now we're kind of just floating around, kind of moving in and around this area. The bond volatility index, or the MOVE index, is rather elevated here too as well. And there's a lot of talk about rate cuts coming, right? The Fed is looking to cut potentially here in September. Depends on obviously data, and that data could have to deal with here inflation data that's coming out on Wednesday. We have PPI here on Tuesday. there's about a 50% probability we'll get a 25 basis cut, and there's pretty much 100%, almost 100% probability right now, priced into the Fed Fund futures, that will get at least a rate cut of some sort in September meeting. And we don't know what Jerome Powell is going to come out and say. Now, while this is all taking place, this is also, just to note, right, we're in an area where if you look back to before the pandemic, 2008, great financial crisis, or dot-com bust, where the yield curve started to uninvert after we started also starting cutting rates, it never ended up being that good of a situation. So just a bunch of strange stuff taking place. Let's look at warning number 5. This one I posted out on Twitter, and I want to revisit this. So yes, year to date, the number one sector for the S&P 500, there's 11 sectors that make up the S&P 500. Okay, utilities is leading the way. Utilities is known to be a risk-off sector. So when utilities outperform S&P 500, that right there, it doesn't necessarily mean that the markets have to come down, there's crash, there's some big things happening, whatever, but notoriously it is known to be more of a safe haven asset, right? A flight to safety. But while that's taking place, I wrote this tweet because there's a little bit more to that. So utilities, yes, indeed is the top performing sector of the S&P 500. As of early August, the utility sector has shown strong performance, which typically for a sector considered a safe haven, right? We just said that. Additionally, though, consumer staples and healthcare. So consumer staples and healthcare, right? Which align with the reputations of also safety sectors. These sectors tend to be less volatile and more resilient during economic downturns, making them more appealing to cautious investors. Now, regarding the tech sector, there was indeed a notable bounce after the prior Monday's open, which there was, right? When we gapped down, we saw that bounce. But this is the important thing. While this was taking place, a rotation away from these sectors, which would usually signal more of a risk appetite, that wasn't really observed. So yes, tech, right? Technology sector is bouncing here, but what is things like utilities doing? Well, utilities is still floating around, consolidating here near year-to-date highs. So it may be worth looking at these individual names, look at these top 10 holdings, which we're not going to do in this episode, but I have a close eye on NEE. That looks like a great trade setup. It looks very similar to this chart, go figure. But there's also Southern, I forget the name of this one, SO, but then Duke Energy and then CEG, AEP, SRE, right? That's another one that I traded. But then go to consumer staples. Consumer staples is also a day separated from its year-to-date highs. This one didn't really come off. Can it later? Potentially. But then you could look at names like Procter & Gamble, Costco, Walmart, right? Coca-Cola, etc. Philip Morris, right? They're all holding up rather well. And then you have healthcare, another defensive type sector. And we have big moves in Eli Lilly. We have UNH, J&J. Those are some of the top holdings. But overall, we did recently break out of this channel. And we're a day or two separated from the high for the year. Okay, so yeah, technology, we saw a nice little bounce. Even today, if you look at the heat map, NVIDIA was really the only thing that really held things together here. It was up, I think, around 4 to 5%. So you might be thinking, well, why are we bouncing here? Is it bottom? Well, we also got pretty extended to the downside. If you look at the bullish percent index, where you had a low, a higher low, you had a low, and a lower low in the index, which is fairly an oversold condition reading. If you look back, we found bottoms in these areas. So is this just a temporary little bounce, or will it potentially turn into something a little bit better? That's yet to be seen, which we will talk about kind of how to navigate that here shortly. Let's take a look at warning number 6, and that has to deal with volatility. More specifically, let's take a look at the volatility of volatility. This here is the VVIX, and you gotta just be aware that, but usually it trades under this 111, 110 area. A lot of the time it spends there, but in 2020, 2021, this area, it did trade a lot above there in and around the pandemic area. And right now we're well above this 110 area, which we don't usually spend too much time around. But even today, the volatility index was actually up, trading up north of 120, which this isn't something to just kind of like, oh, it's no big deal. No, the volatility is quite high here. And even look at the daily time frame, right? If we zoom in a little bit, that was the weekly time frame. You could see it kind of came into this 110 and it found itself a little bit of a move higher from there. And while this is taking place, the VIX, which is the volatility index of the S&P 500, today we started to see it come off, right? After a big rip higher into the 60s, which I don't even know if you want to look at the 60s, because this was, I'm pretty positive that was actually happened in the pre-market session, Okay, so needless to say, we closed at 38, which is a high reading, which it's very rare to actually do that. And we started coming back in, and we're still here in the 20s as it kind of came to fill this kind of gap on the VIX. So needless to say, this is high. This is rather elevated, which implies about a 1.32% daily expected move. Speaking of expected moves, if you look into the options chain, the SPX tomorrow has a $50 expected move. The SPY, a $5 expected move. The Qs, a $5.33. The IWM, a $3 expected moves. This is a 1 standard deviation move here. This is a 2 standard deviation move here. If you want those levels on your screen going into August the 13th. These are large moves. And to me, this is showing us that, hey, volatility is here. It hasn't abated by much, right? It was higher than this, but these are still very large expected moves in the S&P 500. Let's go to warning number 7. And I think people are familiar with what's been going on about the yen carry trade, but I think it's still worth noting a couple of things here from a technical standpoint. This is the Nikkei. I think it's Nikkei, how you pronounce it. I could be wrong there. But we saw a massive move down, a lot of volatility, obviously, and people were like, oh, it's up 8%. That was an inside trading day after a down 13% day, and we're just kind of bouncing from this area, which is more than normal in these markets. And the reason why people have been pointing the yen carry trade out is because there has been somewhat of a tight correlation between the USD JPY and the NASDAQ 100, how you can see they broke and they kind of fell together. Well, my thought is this: if you go into the Japanese yen futures, I mean, we saw a massive move, and now it's just kind of coming in a little bit here. So what happens if it starts breaking out further? And from everything that I could find on the yen carry trade, nobody knows how big it actually is and how long it could potentially last as far as an unwind goes. So buckle up. If it's not over, we can potentially see this still bring in more volatility. Okay, so how do we navigate this? I think that's the most important aspect, and that's what we talk a lot about here on this specific show. I can talk about warnings all day long, right? But there's obviously, you don't want to let warnings deter you from when things start to shape up. And the things that I really look for, so for example, the most recent thing that we've been talking about is looking for a follow-through day. And a follow-through day after a correction in the markets gives us a little bit more confidence to say, hey, I don't care what the headlines are, what the news is saying about this or about that. It tells us, hey, after seeing a follow-through, we can get some more exposure back into these markets, feel a little bit more confident, and we can slowly get back into it after seeing validated strength. And if it turns back around, because it doesn't always mean 100% accuracy, we can get out. But at least if it does start moving further and further to the upside, we have exposure in the markets. So if I look at the SPY on the daily time frame specifically here, this was the low. This was the day one of the attempted rally. And if you haven't watched this, watch my last video. I go into this in more detail and I show you examples in the past. Now, today was day 5 of the attempted rally. And one thing is very important here that I'm noticing. The range of the candles are getting a lot smaller, meaning that we see authoritative moves, right? Expansion, authoritative moves. And now all of a sudden, you get a smaller candle inside day, a smaller candle, and now even a smaller range candle. So the volatility here in this specific move is contracting. Volume is drying up as we're moving into a catalyst event, PPI, CPI, etc. Okay? So volume dries up, this dries up. You got to be very aware if we start breaking to the upside and or to the downside here, because if volatility expands, if the candles start to expand in that certain direction, it could be one heck of a move. Now what is a follow-through day? Well, typically from day 4 through day 7, we really start to look for them. We didn't get it here, we didn't get it there. So we have a couple more days, and it's likely to see some sort of a follow-through if it's going to work out. What and does it have to be day 7? It could be day 8, day 9. It's happened in the past, but a follow-through day is about a day that's up 1.25% or 1.2%, and you need more volume than the day prior. So, for example, if tomorrow we finish up 1.21% or whatever, just let's say 1.2%, and volume came in higher than the day prior, that would actually be considered our follow-through day and give us a sign to get a little bit more exposure into the markets at least and start going from there. Okay, so that's one thing that I'm looking for specifically. That's very specific, something that I'm looking for to get more exposure into the markets. Because right now, I'm just kind of letting the markets do its thing. I don't care about catching the bottom. I care about catching the move up and away, not necessarily catching the tops and the bottoms. Okay, the other things that I look for is being in positive gamma territory, and we're just not there yet. The gamma flip line is right now at 54.40. We're currently below that. We're not far off. And these can act as kind of ranges and zones, okay? But when we're in negative gamma territory, selling begets selling, buying begets buying, volatility typically increases, liquidity typically dries up. I've shown you many examples of what it looks like compared to the VIX when we're below a gamma flip line. It typically starts to rise and trend. And when we're back above it, when we're back above the gamma flip line, all of a sudden volatility comes off and we start to see more consistent selling the rip, buying the dip, selling the rip, buying the dip type of movement. So that's one specific thing that I'm looking for going into this week, potentially next, and so forth if we don't get there sooner. The next is obviously the 5-day moving average. The 5-day moving average we're currently above right now, and that's a positive sign. So very short-term positive, right? We have a low, a higher low, a higher low. We have a high, a higher high, and a higher high. So in the very, very near term, right, which we went over the daily and all that stuff and explained it more, that's good to see. We're above a rising 5-day moving average. So I'm looking to add exposure now more to the upside. It's if we start breaking down, you got to be obviously more careful. And that goes without saying as to why, right? We're seeing wedges structure that's kind of like a bear flag, and we haven't got our follow through day, etc. So one thing that I'm still looking at here is you just anchor a volume weighted average price to the last swing low. You can go even lower if you want, but this would be the last swing low. And I'm just seeing how price, if it does come into this area, if we're going to hold up and around that area. As it stands right now, right, price action is getting pretty tight even right here. So break higher, we can look for the upper daily expected move come tomorrow, and potentially even the upper weekly expected move too as well. Depends on what the PPI data is. But the weekly expected move, the expected risk range, right, for what the market's pricing in as far as risk this week, it is rather large, right? The specific number here for the weekly expected move on the SPY is $12.03. That would bring us to 545.02 and or down here to 520. And if you think of this as a distribution curve, 68% of the time, we close within this range. So that is what I'd be paying attention to for the week. And then going into tomorrow, I'd be paying attention to these two levels, which is that daily expected move. That's all I got for you on today's episode, everybody. Hope it gave you some insight into some of the warning shots that I'm seeing behind the scenes, but yet give you some encouragement and what to look for potential opportunities if all of this is just, I don't know what the good word is, but if all of this is just nonsense and the market wants to continue to track its way up, we got to be there for that as well. See you later.